Hi, this is Morgan Smith, partner and financial advisor with WorthPoint. Today is Thursday, May 11th, 2023. And welcome to a first of a series of videos I'm going to bring to you on a timely basis to discuss um, topics pertaining to financial planning, wealth management, and investing that I think might be relevant to you. And the whole idea here is to differentiate some of the things that you may be hearing out in the media and thinking in your mind what's going on um, from these different aspects of the media and what we're listening to versus what we're seeing as professionals from an academic standpoint. So I hope you like them, and I'll have more to come. Today's video is on inflation and investing, and today we're going to look at, how what's inflation looking like right now? How could it affect us in the future? Specifically, what it's looked like historically with inflation. So I'm going to share my screen here. And the first thing I'm going to do is introduce you to Fred. Fred is the Federal Reserve Economic Data website, and it's managed by the research group uh, at the Federal Reserve there in St. Louis. And let me get this to scroll down here for us. Bear with me. So basically, what does Fred do? Fred is looking at hundreds of thousands of economic sources out there, both nationally, internationally, public and private sources, and it basically collates all this data and they put it all together, and then they um, put it in formats that are as information and graphs and things like that that we can look at and provide some perspective on. So that's the first thing we're going to do is we're going to use Fred to look at historical inflation. If you look here, Fred's looking at the CPI, and we can go back to 1977 on this. We're just going to go back to the 80s here. I think it's a good thing to look at from perspective. In the 80s, inflation was 13.5%. And then it went down and it kind of bumped around a little bit here. And as you know, inflation was relatively low in 2020 at 1.2%. And then all of a sudden it jumped up significantly. And as of May 9th, 2023, inflation sat at 8%. So again, this is all on our minds. I know we're all feeling it in our wallets, at the fuel pumps, with our energy prices. It just seems like everything is getting more expensive these days. And the question that a lot of folks that I've been speaking to have had is, what's inflation going to look like in the future? Is it going to be higher? Is it going to lower? Is it going to be staying the same? And nobody can predict the future. And the having said that, Fred um, actually has some data points that we're going to look at here. And this is called the 5-year break-even inflation rate. What does this tell us? The latest value implies what market participants expect inflation to be in the next 5 years on average. So again, nobody can predict the future precisely, but if you look at the marketplace as a whole and all these data points, what is the best information that Fred can give us is that in 5 years, on average, inflation will be 2.13%. And that's as of May 10th, 2023. So I know from my perspective, that's pretty good news. If I didn't have any other indicators, I didn't know what was going on. The 5-year break-even inflation rate tells us that the inflation is going to drop, and it's going to be in kind of the norms of what we've seen historically over time. Typically, when we're putting in inflation rates in financial planning, we're putting in averages about 3% historically. Why is that important? Well, you want to make sure that when you're doing your planning and looking at your investments, you want to have your wealth exceed inflation. And that's why people invest in securities and things like that. We know if you just put your money under the pillow and just let it sit there, you're actually losing money to inflation. So ideally, you want your investments to achieve some kind of return. In most cases, in many cases, that's above and beyond inflation. So your wealth sustains your lifestyle and your goals and needs over time. Now, the next question we want to look at is, how's inflation affected investments, and are, for example, investments in stocks a good place to be during times of inflation and different periods of different kinds of inflation. So, in the theme of curating good articles and information for you that I think are timely, we're going to look at a nice article from Dimensional Fund Advisors. Will inflation hurt stock returns? Not necessarily. So, what they did is they took data from Dow Jones, S&P Dow Jones indices, and they went back to 1992. And what we're looking at here, the green bars, are annual inflation adjusted returns of the S&P 500 index. So a couple things to note here. Number one, these are inflation adjusted returns. Oftentimes you're seeing returns as, say, the S&P 500 did 10%. But if your inflation was 3% that year, for example, your real return or inflation adjusted return is the difference between those two, 10% minus 3%, which is 7%. So the idea, again, is let's try and get a return, in many cases, above and beyond inflation. Excuse me. I think the other thing to note on this chart in the disclosures here, since we're looking at a commercial index, which is the S&P 500, we all know that we as investors cannot invest directly in commercial indexes like the S&P 500, the Russell 2000, an emerging markets index, and so on. So it's important to note that the performance of this index data does not reflect the expenses associated with the management of an actual portfolio. So now that we've gotten that out of the way, let's have a look at what we can glean from this chart. Again, green bars, S&P 500, 1 year real return. So that's inflation adjusted. The red dot is going to be the inflation on any given year. So let's take a sample year, 1995. In this year, inflation or real return of the S&P 500 was just below 35% here, looks about 34%, while inflation looked to be about 2.5 to 3%. So that's a good year if you're a stock investor, and your real return, if you were invested in the S&P 500, would have been something similar to this, not exactly the same. What can we glean from this chart kind of in a broad perspective? Although this is just from 1992 to 2021, and we know we've got market data going back to the 20s for the S&P 500, or significantly back many decades. What we see as a trend is that most years, if you look at the stock market in the U.S., are positive. So there are more years that are positive and less years that are negative. And it just so happens that this time sample reflects the same thing. But there are years where the market's going to go down, and we know that. And kind of riding through those fluctuations is something that we have to accept for long-term rewards. So, for example, in 2008, that was a financial crisis. The S&P 500 was down greater than 35%. And during the pandemic, the S&P 500 was down, it looks like about 6% here. So what we see here is, look at, even though there are years of inflation, the S&P 500 has in fact delivered returns above and beyond inflation. So that's a good thing. I think another broad stroke that we can glean from here is that if you look at inflation during this time period, it was fairly tame, I would say. And there was a year, for example, in 2007 and 2005 here, where you did have a positive return, but that positive return didn't exceed the rate of inflation. So you actually lost money invested in the S&P 500 relative to inflation. And certain investments that are more conservative, you may find that there are more years where the investment return is less than inflation. So that's something to look at when you think about constructing your portfolios. So another thing we can glean here is that when inflation spiked up here in 2021, uh, that year the S&P 500 index did just fine. It returned just about 20% return. So how do we boil this down? Well, let's look and see what the article boils down. I think it says it very clearly and succinctly. History shows that stocks tend to outpace inflation over the long term, a valuable reminder for investors concerned that today's rising prices will make it harder to reach their financial goals. So the takeaway here is sure, yep, looking at this example here, the S&P 500 was a great place to be since 1992 to outperform inflation over time. There were years where it didn't beat inflation. We also looked at what the projections were from Fred on whether or not inflation was going to maybe get worse, but the projections are in 5 years on average, it was going to be actually within inflationary norms. So, on that note, I hope you found this relevant and timely. I'll do more of these in the future. And until then,